Thank you.
6:01, it's November 8th, 2018. This is the regular monthly board meeting of the Alameda County Board of Directors. And would the Secretary please take the roll?
Directors Gunther?
Here.
Akbari?
Here.
Huang? Here. Weed?
Here.
And Sethy.
Here. And why don't we have our General Manager lead us in the salute this time?
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Okay. So at this time, members of the public may address the board on any issues not listed on the agenda, which are within the purview of the Alameda County Water District. Is there anybody who would like to come forward and speak? Okay, seeing none, we'll close public comments and we'll move on to the consent calendar. And in order to help with the efficiency of this, I'm going to make the motion of what to add to the consent calendar. And I will be requesting that we add item 5.3, 5.4, and 5.5, and we'll come back to 5.1 and 5.2 afterward.
I'll second that motion.
There,
Directors Gunther?
Aye.
Akbari?
Aye.
Huang? Aye. Weed?
Aye.
And Sethy.
aye. And I'll make a motion to approve the consent calendar as amended.
I'll second. Directors Gunther?
Aye.
Akbari?
Aye.
Huang? Aye. Weed?
Aye.
And Sethy.
Aye. Okay, returning to the item 5.1, Director Weed would like to recuse himself on this
Yes,
item.
I will recuse myself. I was involved in litigation with this. While the litigation has been resolved, the project now is trying to come to grips with what the implication of that resolution was. It was CEQA action. So, thank you.
Okay, once again, I'm going to make a motion to approve item 5.1 as is, staff recommendation here.
I'll second.
Directors Gunther?
Aye.
Akbari?
Aye.
Huang? Aye. And Sethy.
Aye. And we can call Director Weed back in. Okay, we'll take up item 5.2, and do I have a recommendation here? Put forward.
I'll move the staff recommendation on item 5.2.
I'll second.
Directors Gunther?
Aye.
Akbari?
Aye.
Huang? Aye. Weed?
Abstain.
And Sethy.
Aye.
I've abstained on this item earlier with prior discussions on this project.
Okay, we'll turn to item 5.6, which is the presentation of the Alameda County Water District's audited financial statements for fiscal year 2017 and 2018.
Thank you, President Sethy. Our Manager of Finance, John Wunderlich, will begin sharing what I believe is a good news item for us.
All right, good evening. The district prepares a comprehensive annual financial report each year that is comprised of an introduction with an overview of the district and recent accomplishments. Just pause right there for a moment to thank the executive team and other staff throughout the district who assisted in preparing that section in the transmittal letter. The financial report also includes an analysis of the financial statements in the management discussion and analysis, as well as the financial statements themselves, which increasingly are a smaller section of the overall report and the related notes. And lastly, there's a statistical and historical information section about the district. The district's auditors, Macias, Genie, and O'Connell, recently completed its audit of the financial statements and issued an unmodified or clean opinion. We do have representation from MGO here this evening who will present a brief overview of their process in conducting the audit, as well as highlighting a few of the key financial results from the prior fiscal year. The auditor reviewed the results of the CAFR with the Finance Committee on October 23, 2018, and acceptance of the CAFR will help the district meet Strategic Goal 3.3, promote financial transparency. And so the recommendation this evening before the board following the auditor's presentation is by motion to accept the audited financial statements and accompanying reports for the fiscal year ending June 30th, 2018. And so with that, I will turn it over to Mr. Bullock from MGO.
Welcome here tonight.
Good evening. Thank you. Okay, so let's see here. Okay, my name is David Bullock again, partner on the engagement. This is my first year as partner on the engagement. Cindy Pond, who you might recall, was the partner for many years from the inception of the audit. One of the things that changed in the state of California is legislature decided that auditors should not audit more than 6 consecutive years. Audit partners should not. And therefore, as part of the legal requirements, we have a standard rotation process in our firm. And so this is my year of taking over for Cindy in the final year of the contract, but I just wanted to point that out. But you may have seen me in past years. I've presented from time to time helping Cindy out when she's had a conflict in her schedule. So we're presenting the 2018 financial statement audit, and as you can see from the scope, there's several reports that we issue for the district. We issue the comprehensive annual financial report. That's your basic financial statements, and then there's some additional information in there to provide context and historical facts. The Government Auditing Standards Report, that's a report that focuses on internal controls and compliance. The Debt Compliance Report, ensuring that the district's complying with bond covenants. And the Appropriations Limit Agreed Upon Procedures Report, and that's it's also known as the GAN limit, ensuring that the district is staying below the spending increases for property tax spending. And then finally, the fifth item on the list there is our report to you, and that's the summary of our audit results. So we'll go over the CAFR first. So the CAFR includes the basic financial statements, and that's your financial statements that have been updated from the previous year. So it includes a balance sheet that shows your position, your net position on June 30th, 2018, and then a statement of revenues, expenses, and changes in net position that shows the changes from the prior year, and a cash flow statement. These were audited in accordance with GAAP, and as you can see, we follow 2 sets of auditing standards: generally accepted auditing standards and government auditing standards. Government auditing standards provide a little more context and a little more guidance over engagement acceptance and being independent, and it also provides requires the auditors to report a little more on internal controls and compliance. As John mentioned, our opinion on the financial statements was unmodified, so we were able to express a clean opinion on the financial statements, and basically that means that we agree with how management has portrayed the financial statements in the report. In addition to the audited statements, there's required supplementary information. This isn't audited per se. There's basically limited procedures on those items, and so we provide limited assurance. And that includes management's discussion and analysis, and that's a very good part of the report. It provides some context to the numbers. You know, when you're looking at a balance sheet, sometimes it's hard to see or interpret what the changes in those numbers mean, and so the management's discussion analysis puts a little context into that. And then a couple of schedules that are required for both pension and OPEB accounting, and I'll talk a little bit more about that. OPEB, those changes are new this year, so that's a new addition to your financial statements. And then finally, the last section is the introductory and statistical sections. Again, provides a little more context. Those are unaudited schedules and information. But it's, I think, very useful. It allows the districts a little flexibility in how they present the financial statements, You could talk about service efforts and accomplishments and other things that you really can't talk about in the audited financial statements. Those are more historical and factual, but the transmittal letter allows you to add a little more color to how you want to describe the year. And then the statistical information is very good when you want to see, what's evolved over time. They're typically 10-year trend information, so it gives you a little bit of historical context when you evaluate the financial statements. We're happy to report also that we had no findings in the Government Auditing Standards Compliance Report, so we looked at controls and material compliance with laws and regulations. The Debt Compliance Report, also no findings, so the district is following its bond covenants and those requirements. And there were no exceptions noted when we evaluated the Appropriations Limit Report. For the financial statements, we wanted to highlight three areas that were most notable in terms of the changes from the prior year. The first one is the implementation of a new standard, GASB 75, also known as OPEB, and that changed the reporting of your OPEB obligation as a number that's based on how you fund it. In the past, you would record a liability only if you weren't making the actuarial required contribution, okay, or the actuarially determined contribution. Now you report the OPEB based on your actual obligation to the employees less the funds that the resources that you've provided in a trust, okay. And so the liability on your books this year is $32.9 and you reported deferred outflows and some other line items, and those really relate to the timing of how you recognize OPEB expense. So the liability on the books, which is different than maybe a funding valuation, the liability is based on what the actuary projects those future payments to be and discounted to a present value. So that's the estimated liability, and then it's reduced by the amount of resources you have set aside to pay those in a trust. Okay, so it has there's no amortization of normal costs or an unfunded liability. It's just the balance at a specific date. So that's new. The pension is not new, but what I wanted to point out for the pension is CalPERS has been making an effort to evaluate the sustainability of the plan, and in doing so has reduced the discount rate and is continuing to try and reduce it to maybe achieve a 6.5, I think is the ultimate goal. But that effect is pretty significant to the liability. So even though the portfolio at CalPERS had a good year, meaning that it exceeded the actuarial projections, it still wasn't enough to cover the increase caused by the lowering of the discount rate. So your liability went up $8 million, even though you had a pretty good year in terms of funding the trust. And then finally, the third area that changed significantly, if you compare the revenues from the prior year to the current year, you'll see a significant increase, and that's the result of the rate increase and having a full year of such. And so you can see that its impacts are increased cash balances and water sales revenue, and as Director Sethy pointed out, a net income that was positive from operations before you get to some of the other subsidies and grants and so forth. So that was probably the three most significant changes that we observed in the financial statements, and we wanted to share that with you. On the what we typically call it a management letter, but on our report to the Board of Directors, there's 7 areas that we're required to communicate as part of our audit standards, and so I just want to quickly go over those. The qualitative aspects of accounting practices. Consistency is very important when you're presenting financial information and making sure that's comparable from one year to the next. And so the changes in consistency, those are sometimes changed because you change accounting practices or policies, but in this case you implemented some new audit standards. GASB requires changes from time to time, like the OPEB. And so the OPEB was the most significant change in accounting practices this year. There were some other financial pronouncements that came out that really had no impact to the district. The second item there is whether or not we had any difficulties during the audit, and we didn't, and we would like to extend our appreciation to the finance department and the staff and management that we worked with here at the district. Very cooperative, and the audit went as planned. There were no material misstatements that we had to correct. There may be some small items that we pass on because they're below any kind of materiality thresholds. There were no disagreements with management, Management provided representations that they provided us information and let us know if there were any issues in terms of internal controls or compliance. And so management made those representations through the date of our audit. And then the management consulting and other independent accountants, if we're aware that management's bringing in others for, say, a second opinion, we need to be made aware of that. And we do not believe there was any such consultations. And finally, there were no other audit findings or issues to report. So with that, I'd turn it over to you to ask any questions that you might have.
I'll kick it down to Director Weed.
Okay, thank you. Let me start with GASB 75, which is new, as you pointed out, is new to us, and discuss our OPEB liability and unfunded liability and how we account for it. I was concerned that the actuary did not use the board policy guidelines of a 6% payoff by 2037, and rather use 6.75% with payoff in 2039. Now the payoff, the length of time really is a function addressed in the amount of money we have to attribute to every year to it. But the discount rate is critical because that determines the actual amount of liability. And we will do this again in 2 years. I raised it in our budget, in our workshop or committee meeting when this came up. And I would encourage us to review that and see if we should not be asking the actuary when they come in to utilize whatever the established board policy is at the time in making their actuarial estimates. Right now we're out of sync.
Yeah, one of the things that GASB 75 did from previous standards is it divorced the notion that the accounting recognition be based on a funding, from a funding perspective. And so, you could use any kind of assumptions you want and decrease that discount rate and use that to fund a liability to be a little more conservative on how you fund it, but the actuary's got to use a discount rate based on how they've projected that portfolio, that composition to perform. And so that's a good question to ask the actuary when they prepare and they often prepare two different valuations. They prepare a funding valuation for how an organization intends to fund that plan, and then they prepare a GASB 68 compliant valuation. And so in order for them to reduce the discount rate, it can't be based on a policy per se. It's got to be based on the true economic facts and conditions. And so that's a good question for the actuary in challenging them on whether or not the 6.5 discount rate is really appropriate for the portfolio that you're utilizing.
In partial defense of the actuary, on page 53 you show a range of 1% above and 1% below, which shows our unfunded liability going from 38 million to 25 million, depending upon what the actuary, what that number is. But we have control of the OPEB, far more so than we do under other CalPERS when it comes to that liability. I would hope that at some point, maybe not necessarily in the audit, that we would develop some metrics that would identify the multiple. When I'm using these metrics, because these are metrics that were suggested by Moody's in a stress test for public agencies in determining their credit rating. The multiple of the unfunded liability to payroll, and you do the simple definition. Their suggestion was if you went over 8, both PERS and OPEB, then they would consider putting you on a watch list. We're at about 5. And the second was a discount rate of 6% paid in 20 years. Now we have, and we're talking about reducing that that internal payment guideline to from 2037 to 2032. So, and one time when we started, 20 years versus 15 years, and that was done. We had selected 15 years, and then in order to get past a budget rate hearing, we somewhat flippantly said, well, let's add 5 more years, and then we got the votes to get our budget, our rate increase. But so those are just things of import. 75 will evolve over time, and we're 29% funded now. We've got a long ways to go. Thank you.
Director Akbari,
No questions from my end.
any comments?
No, no comment.
Okay, I'll keep mine brief. David, thank you very much for the presentation you gave at the Finance Committee meeting. And I want to just express to you and our board, our public, what I said there, that since you came on board MGO, I really feel that you've helped to improve making our district a much better district for the public that we serve. And it kind of goes a little bit unrecognized. And just for the benefit of the board and public as well, when we first started with MGO, I believe we had about 12 to 16 comments on where we could make improvements in the district when we made the transition from our previous auditor to yourself. And last year was the first, we've been whittling that down every year.
Right.
And last year was the first year we had no comments, and this year again. And so I think it speaks to a lot of the good work that you put in to point out to us where we can make better improvements and efficiencies, and it's also an attribute to our finance staff to get everything implemented. So that's the greatest contribution in the global sense back to the community.
Thank you.
You're welcome. Number two, I wanted to point out to the board, just Table 1. I'm only going to pick one table here, because Table 1 really tells the story of the district over the last 10 years. And I used to make the argument 10 years ago, sitting out in the audience, that we needed to get the water district to the point where product sales, your water sales, covered your operating costs. And it's been a goal of mine from day one.
Page 73.
Oh, wait, there you go. And so each year we've been trying to get there. It's been a struggle because we had to go through the recession and the after effects of that. Then we had to go through the drought years. Each time we were still trying to catch up to that point, but it's taken a persistent effort on the part of the board through our rate increases, the management of our costs, which have only gone up about 50–60% over a 10-year period. And we've tried to keep a cap on headcount, and I think our management team has done a great job just trying to control costs. So this is the first year that water sales by themselves are covering our operating costs for the district. And what that means is that the surplus that we have drops straight down to the bottom line. You can see the change in increase in net position. It went up quite a bit. And the bottom line, in my opinion, is that it gives us a lot more flexibility to pay down unfunded liabilities, to fund our projects without going out to the bond market, helping out the district in a number of different ways. So it's worth going through this, and I would recommend all of the statistical information. It's very thorough and very interesting. So those were my three primary comments, and lastly, I'm just going to close by saying I have all of these CAFRs going back like to 1990 or something, and I think that this financial statement report that we have probably represents the best financial health of ACWD ever. I mean, we've achieved something really good here in the last year. And hopefully we can keep it up.
And I just want to point out, I think that, management and the staff prepare the document. We audit it and we provide our input, but they're really responsible for putting this together.
Right.
I want to recognize that.
That reminds me, I also want to thank the staff here, because I thought this was the finest write-up on the introductory to the CAFR that I've seen. It was exceptionally well done. And I was learning a lot from it.
Well, thank you, and I just like to reiterate that's a team effort. It's not just out of the finance department. It's really everybody involved in putting that together.
It's well worth reading. So thank you very much.
Thank you.
Sethy, if I could just
Yeah.
embellish on your comments for a moment.
Sure.
We talk about positive funding and full funding, positive net operating expense. That's wonderful. What it means is we have enough income to cover depreciation. And in the past, we were, at that time, just worried about cash flow. Did we have enough money to pay our bills? And not worry about having money to maintain our system. We could always borrow for maintenance. Now we have the ability to be a little more honorable in our bond actions and do it for capital improvements as opposed to deferred maintenance.
Okay.
Thank you.
Thank you.
Thanks a lot. And just a added comment from our finance meeting, it looks like we'll probably be in the ballpark of water sales covering our operating costs this fiscal year. We might be a little bit below, a little bit above, but we're going to be close again.
Right. The concern is going into the next year and what our rate increase is needed to cover that if we don't have increased water sales.
Right. Let's leave that discussion for later on so we can close out this item. All right. So as chair of the Finance Committee, I would like to make the recommendation to approve staff's recommendation here to approve the new audited financial statements for fiscal year 2017-18.
Second.
Directors Gunther,
Aye.
Akbari,
Aye.
Huang,
Aye.
Weed,
Aye.
and Sethy.
Aye. Okay. At the request of staff, we are removing 5.7 from the agenda. Would the general manager like to make a comment? Thank you, folks.
Thank you.
Thank you.
Just brief comment. We plan on covering the material that we planned this evening on item 5.7 at a board workshop on December 6th. That's a Thursday at 4 p.m. Here at headquarters. So we'll be able to do a deep dive into this material at that time. And thank you, directors, for being available for that workshop.
Okay, so that item is scratched from the agenda, and we'll take it up on December 6th. Item 5.8.
Thank you, President Sethy. 5.8 involves a resolution adopting proposed revisions to the board's procurement policy, and Mr. Wunderlich will again lead us off on this item.
All right, thank you, Mr. Shaver. The district's procurement policy specifies which types of procurement require board approval and which types may be undertaken by staff, primarily based on estimated contract cost limitations. The procurement policy also specifies the procedures for awarding different contract types and for authorizing the general manager to award contracts and approve change orders and amendments to those contracts. The district has been working under the same procurement policy for approximately 6 years and recently undertook a review to determine what opportunities there may be for some efficiencies. And so we did institute kind of an internal work group to take a look at that, and what you're going to see this evening that's recommended is the results of that internal work group. The proposed changes have also been reviewed by General Counsel, and the policy was reviewed with the Finance Committee on October 23rd, 2018. Approval of the proposed procurement policy will help meet the district's strategic goal 3.3, promote financial transparency. And so right now, what I'd like to do is introduce Ms. Rosalind Fuller, the district's purchasing officer, for a brief presentation of the key proposed changes in the policy. So with that, we'll turn it over to her.
Good evening. Good evening. As John said, we're going to just try to highlight some of the major changes to the policy. Some of the other ones were just wordsmithing the policy and trying to make it more clear for staff to understand the requirements that we need to do for procurement in the within the district. So the first thing I want to cover is that the policy, as John mentioned, was adopted. The last one was adopted in 2013. So staff have been working on with this policy for the last 5 years, and we identified some opportunities for improvement. The general manager put together a task force with different staff within the district to identify some recommended changes. The first thing they wanted to do is separate the policy from the administrative guidelines. They were combined together in the policy, and we wanted the policy to kind of have a higher authority than the administrative guidelines. And so we're making a recommendation to separate the administrative guidelines from the policy. And then the second thing is we are making a recommendation to increase the general manager's authority. I can't see that much, so I'm going to go off these notes because I can't see that thing. To increase the general manager's authority from $50,000 to $100,000. This is for contract awards, contract change orders, and subsequent change orders after an item has come to the board and the board has approved it. We did a market survey of different water districts within our area, and we're asking a recommendation to increase this limit to be in kind of in the same compliance with other agencies that have increased their general manager's authority. So this chart represents some of the market surveys that we went out and surveyed the other districts. Contra Costa Water District general manager's level is $100,000. Union Sanitary District is $100,000. Delta Diablo Sanitary District is $100,000. Coachella Water District is $75,000. Santa Clara Valley Water is $225,000 for professional services, $25,000 for construction purchases. For non-competed purchases is $50,000, and then for competitively bid is $100,000. I'm sorry, it's unlimited. There are some special conditions for Santa Clara Valley for competitively bid procurement projects, non-constructions that do not require the board authority is a $225,000. Eastern Municipal Water District is $100,000, and then South Coast Water District is $100,000. So as you can see, most of the general manager's authorities, based off the market, has increased their authorities, and so we're making a recommendation based off our survey. Our next recommendation is methods of procurement. So we wanted to clarify the difference between informal and formal competitive bidding. For items that are informal, it really only requires us to get one quote, and then for competitive bidding, where there's sealed bids, it's we put it out to the general public. We use our bid system, put it out to the general public. And those bids are sealed, and it's a more formal process. So we wanted to clearly define in the policy the difference between the two. And then we're asking to increase the informal bid limit from $5,000 to $10,000. Procurement believes that we don't really add that much value to commodities less than $5,000, and so we're asking to increase that limit so that they're more strategic and we have more dollar savings when procurement puts something out to bid. So we're requesting to increase the single transaction limit with a caveat that when a requisition comes to procurement and it's less than $10,000, if we know that we can get a better price with the market, then we'll put it out to bid. So we're looking at trying to do cost savings. We're not just giving them carte blanche to purchase for up to $10,000 without doing some competitive process. Section I is the single and sole source procurement. We wanted to develop some language to define the single and sole source procurement and when it's appropriate to use a single and sole source process. The recommendation is to give the general manager authority up to $100,000 And then anything over 100,000, the board would have to approve that single and sole source procurement. And then Section K is emergency contracts. We developed language in the policy to define what an emergency was, and then to recommend the general manager to have authority to authorize the general manager procurement authority in the event of an emergency, and then his requirements that he needs to meet to bring back to the board any time he has used that authority due to an event of an emergency. So we developed some language in the policy to define an emergency and what his authority is and when he needs to come back and report back to the board when he's used that authority. So again, our recommendation is to adopt the resolution to revise into procurement policy. And I'll open it up for questions.
I don't have any.
No comment. Thank you very much for some great work.
Thank you.
So one outcome of these, thank you, Board, for your consideration of this item. I just wanted to point out that one desirable outcome is that you'll see that you will not be waiving your procurement policy very often at all. Because, as I'm sure you recall, we would come to the board and ask you to waive procurement policy number 1 for certain situations. Those situations are embedded in the policy now, so we won't be asking for that nearly as frequently.
Right.
Could make for quicker board meetings.
That was part of the plan.
Thank you.
Thank you.
Well, I will make a motion. I will make a motion to adopt staff recommendation.
Is there a second?
I'll second.
Directors Gunther? Akbari?
Aye.
Huang? Aye. Weed?
Aye.
And Sethy?
Aye. So we'll move on to Section 6, reports. Anything under 6.1 under board committee reports? Seeing no comments, okay, we'll close out 6.1. What about operational reports, 6.2?
So, staff would like to make a brief presentation on the quarterly projects review. We have a couple of projects that Mr. Stevenson would like to highlight.
Mr. Shabrin, in keeping with the short board meeting comment, I can just quickly go through a couple of highlights on the fish passage improvement projects and a quick look at the timing for the advanced metering infrastructure project. And so starting off with the rubber dam number 3 Fishway project, the board knows that construction commenced last spring, and much of the construction work has been completed now. The project construction has moved out of the channel and is now focused on outfitting the fish ladder structure itself with electrical and mechanical instrumentation and improvements. And so currently the contractor is on schedule to meet the December 18 contract completion date. And I just thought I'd show a couple of photos from the construction process. What you see here is a lot of activity on the existing rubber dam number 3 foundation, which was modified to provide for fish passage. And so you can see there was a lot of activity, a lot of concrete pours going on. Here's a photo looking upstream toward the east of the Fishway structure itself. It's here the structure is nearly complete. This photo's from early in October, and it shows in the foreground, let's see if I can get this to work, in the foreground here, shows a lot of stubs for instrumentation and controls. That's where the cabinetry will be placed. Here's a view of the rubber dam fabric after the district received it. You can see there was a big 9-axle truck to deliver this 50 tons of rubber dam fabric to a district site, where it was unfolded, prepared for installation at the foundation, and then sort of refolded in a way that could be installed down in the creek. Here's the rubber dam, the new rubber dam fabric in place. You can see it's being inflated here in this photo. It's about a half a PSI in there as part of one of the operational tests of the facility. So that's what the channel looked like a couple of weeks ago. And here's what the flood control channel looks like now. The rubber dam's in place. Here it's deflated. There's about 10 CFS of natural creek flows in the channel. And then the photo down in the lower right just shows the status of the Fishway. Now you can see the work that's being done to outfit the structure itself with various mechanical components. So that's the status of rubber dam number 3. Rubber dam number 1, as the board's aware, the board took action on the cooperative agreement with Alameda County on October 11, and then the project was advertised for construction on October 12. So the bids are due December 6, and depending good bids, our plan is to be back to the board to consider award of construction at the January board meeting. And of course, construction would be scheduled from spring 2019 through the winter of 2021. Just quickly touching on the advanced metering infrastructure project, just wanted to talk about the timing and reset.
Before you go,
Sure.
I just ask a quick question here on the fish ladders.
Sure.
So you took the committee out for, was that Jim and Judy? Okay.
Correct.
Saw you in your hard hats and everything, pictures. So I was out that same morning that the committee was going in the afternoon. And so there was no water running in the channel. The rubber dam was just flat on the ground.
Correct.
So what I'm wondering about is, now that you have water flowing through the channel again, has all work suspended around the fish ladder? Or is that complete? Is it just instrumentation?
Yeah.
What's the status?
So all of the work down in the channel is complete. There's still work happening in the fish ladder and around the fish ladder on top. There's mechanical, there's valves and slide gates and control equipment and all that sort of work happening at the fish ladder structure itself, but the work down in the channel is complete.
Wow, because it looked like there were at least a couple of more months to go.
It was a lot of activity over the last couple of weeks, yes.
Wow, okay.
As you know, there's some very strict permit deadlines for getting out of the channel in a certain period of time. In fact, we had to work with the resource agencies on a couple of extra days to make sure that we were completing all of our activities in a way that made them satisfied.
I talked to a supervisor out there who said, we're planning to get everything done by the end of the year. Is that the...
Yeah, correct. Well, December 18 is the contract completion date. So, yeah, everything is supposed to be done mechanically, testing, operational testing, everything installed within the next few weeks.
Okay, great.
And just quickly touching on the AMI project, and this is really just to reset the schedule for certain upcoming milestones, which are slightly different now than what we've talked to the board about recently. So as the board knows, we're approaching the end of our first major phase of the project, which included a number of things as listed there. The little white circles are sort of the board touch points. These are the major ones, not all of them. But we're approaching phase 2 now. And we still have a bit of work to do yet in phase 1, primarily to present other findings related to the technology, what we call our design report. We also want to circle back on a bit of the financials, that we provide some additional sort of supplemental financial information that flowed from our board meeting presentation last month. And as discussed earlier in this meeting, the proposal is for a board workshop on December 6th, where we would talk about those supplemental financials, and then also have a little bit more opportunity to talk about that design report, some of the technology issues, and then talk a little bit more about the next steps in the program. And then further action on the consultant services agreement with EMA would be tentatively moved to January. So that's just a quick update in terms of overall timing for the project, and I'd be happy, of course, to address any questions.
I have no additional questions. Okay. I'm looking forward to that workshop though.
I would like to make one comment on the hardness report, if I could.
Yeah.
I'd like to thank staff again. I think the highest number I'm looking at on the hardness report is 161. And I just wanted to point that out. It was nicely done. I almost wonder, are the wells turned on? Or, I mean, at 161, nice job, and compliments to the staff.
Thank you. And I would comment the last week of October, the first week in November, it was a little bit of a challenge because San Francisco switched its source of supply to ACWD to its local Snow Valley water treatment plant. So the hardness went from 10 to about 90, and so it was a little bit more of a challenge to meet the 150 hardness target. But we did it.
Mr. Peterson, I noticed that the hardness levels went up in South Fremont quite a bit from where they were the prior reporting period. So I was trying to figure out where, was there a change in water or anything, but it looked like it was the same kind of water distribution between our different sources.
A good observation. Actually, DWR has been drawing down Lake Del Valle. So Lake Del Valle is a little bit harder than water from the Delta. So that was the result of the slight increase in hardness from water treatment plant 2.
Because we went from the 80s all the way up to the 130, 40s.
Mm-hmm. That's the reason.
Okay. Still good water. All right, so we'll turn to item 6.3, which is the staff presentations.
And again, Mr. Wunderlich will kick off another finance-related item.
Thank you. Well, I'd like to invite Isaac Chu from PFM to come forward to make a presentation this evening. This is our annual presentation to the board on the performance of our investment portfolio, which continues with certainly the expertise from PFM to beat the benchmark. So I'll go ahead and turn it over for the presentation.
And just to note, Isaac is a Fremont resident.
I am a Fremont resident. Thank
and
you.
A ratepayer.
I appreciate being here. So I will be giving you an update on the investment portfolio. Please feel free to ask any questions as I go along. So on the first page here, just highlighting some of the key themes throughout the fiscal year. And you'll see at that top bullet some of the key market drivers for the fiscal year of 2018. And that consisted of strong economic growth. We actually saw U.S. GDP at the end of the second quarter, end of the fourth quarter for the district there, exceed 4%, so ending at 4.2%. Third quarter GDP, or in first quarter GDP, is now at around 3.5%. So we've seen positive growth in the health of the U.S. economy. The consumer confidence has been at a 2-decade high, so the highest since 2000. A lot of that has to do with the low unemployment rate and the fact that we are seeing wage growth starting to happen. Inflation is also starting to present itself further in the economy. It is currently at the 2% inflationary target by the Fed. So if we should see more inflationary pressures happen, then the Fed should be more likely to continue to raise rates. As we know, at the end of the fiscal year, the Fed was actively raising rates throughout that year. And every time they added rates, there was by 25 basis points. This caused short end of the yield curve and U.S. Treasury rates to essentially move up every time the Fed raised rates. So we saw U.S. Treasuries move, and quite specifically at the end of the fiscal year, we started to see longer-term U.S. Treasury yields, which have been suppressed. So longer-term being 30-year, 20-year and 10-year start to move up, which they have not done. Ending the fiscal year, the equity markets looked positive. Recently, we've seen a lot more volatility in the market, and we've given a lot of the positive return back recently. And then throughout the fiscal year, geopolitical risks remained. So a lot of folks ask, where are we on the cycle? Where are we, and should we be coming to an end? And what we've put together here is on the left various indicators that show where we are, either late stage being the yellow, early stage being the dark green, and then mid stage being the lighter green there. And what you'll see is the duration or the length of the cycle since the recovery happened at the end of 2008 and started happening has been quite long. So we're in the late stage of that cycle. When we think about the unemployment rate being at around 3.7%, that's very, very tight labor market, very low. That's also a late stage indicator. So when we look, in general, most of these are showing that they're we're maybe mid-cycle. We look at the right, which is the graph of the Conference Board leading indicators. This is a forward-looking metric. And what this contains is certain indicators such as the average hours worked by manufacturing workers, right? So if we see more manufacturing working hours being recorded, that means future growth is happening. Or new building permits that are being issued. If more building permits are being issued, then that's future growth. So when we look at those leading indicators, it shows that there's still potential room for the economy to grow, and you can see that by both of those blue and red lines. And then we've highlighted the gray bars, which are where recessions have happened. So according to this chart, it actually looks like we haven't turned the corner yet, and we may still be continuing to move upward positively in this cycle. So, will a correction happen on the horizon? Likely. But is it going to happen in the near term? According to this, we're saying not likely. So I talked a little bit earlier about the Fed raising rates and that moving the Treasury yield curve. And what you can see here is fiscal year over fiscal year what the yield curve has looked like going out 10 years. You can see on the bottom, on the chart there on the left, the bottom yellow starting in June 30, 2016, the blue June 30, 2017, and then the gray June 30, 2018. And what you'll notice again is a consistent increase overall in yield. If you look closely, you'll notice that the shapes have also changed. And by the shape, I mean, let's see, this one. There we go. The shape that I'm alluding to is right around this 5-year mark, there's a kink that starts to happen, and then it smooths out. And the magnitude of positivity in the graph here is greater than it is here, and it's greater than it is here. And what that essentially means is if you look at the bottom axis, that's maturity. And then on the left, that's yield. So what this is saying is as you invest longer out, you're actually not necessarily getting compensated more. So we've seen a flattening of the yield curve. So this essentially means that, as the Fed raises rates, they're really impacting the short end of the yield curve here, and the long end of the yield curve prior to the end of the fiscal year was actually suppressed. And a lot of that suppression has happened because of quantitative easing that took place. The Fed buying bonds in the open market dropped long-term yields down by about 1%. The yields of U.S. 10-year government bonds are also the most attractive yields globally. So there's a lot of demand for U.S. Treasuries, keeping the rates and the yields low on those bonds as well. So again, what this means is you're not getting compensated for investing further out. So in sense, in this market, with rates going up, it makes sense to be shorter. So on the left, there's some of the accomplishments that we're highlighting for the fiscal year. You'll see that the investment income rose to $2 million. The portfolio yield rose to 1.95%. We outperformed over the fiscal year on a relative basis by 21 basis points. You'll see that we still had a negative quarter, but we beat the benchmark, which is preservation of capital and protecting. In this rising interest rate environment, it's a headwind for fixed income investors. And essentially that is because when rates are going up, new bonds being issued are now being issued at a higher yield. So if you are holding a 2% bond and the Fed raises rates and all new bonds are being issued at 2.5%, then if you wanted to sell your bond in the open market, you have to sell it at a discount. And that's the natural ebbs and flow of fixed income, and that's the current environment we're in, and therefore we're trying to protect the portfolio from that impact. We've diversified the portfolio and we've maintained diversification. We've maintained compliance with the district's investment policy, which is governed by California code. And we've also kept staff informed of current events happening within the portfolio. On the right there, highlighting some of the key strategies, I talked a little bit a second ago about this being a difficult environment for fixed income investors. So we've essentially, been trying to perform downside mitigation risk, essentially trying to preserve capital and protect the portfolio. So how do we do that? Well, one, we invest in high quality assets. They're less sensitive to the fluctuations in interest rates. Two, we want to maintain broad diversification, and that essentially means spreading the risk across many baskets. So not necessarily putting your egg in just one basket, but putting it across many different baskets. Lastly, we want to manage the portfolio's duration. And essentially the duration is the portfolio's sensitivity to changes in interest rates. And we do that by keeping the portfolio shorter in duration. Again, as you invest longer, you should be getting compensated more in most markets. But the longer out you invest and the longer duration of the portfolio, the greater the volatility to changes in interest rates. So we've been shortening the portfolio. We've been trying to find opportunities from moving from one sector to another based off of relative value. So we're looking at how much do you get paid to own a U.S. Treasury over an agency bond, and does it make sense to take that risk for that incremental yield spread. And so those are the types of trades that the portfolio management team looks at. We also look to take opportunistic trades, meaning if there's a new issue coming to market that looks really attractive and it's got strong fundamentals, then we'll want to participate in that deal. So this is a portfolio's total return performance, and you can see on the fiscal year there, we outperformed the benchmark. This is a negative return, again, the headwind from the rising interest rate environment. But one thing that I'll note that is this is a fixed income portfolio. And when I talked earlier about the having to sell your bonds in the open market at a discount, well, the nice thing is you don't have to sell your bonds at a discount, right? You can hang on to them until maturity or until the environment changes, which does not impact the realized losses. So this factors in unrealized changes in market value. And as you can see, we've outperformed the benchmark over all periods since inception there. So the cash earnings here have been going up. And as you can see here, we ended the fiscal year with $2 million in cash earnings and 1.95 in yield. And you can see where we were versus prior fiscal years and how the income is going up as the interest rate environment climbs. And that's, again, a natural part of the fixed income environment. So we are actively looking to continue to increase this yield so that we can gain more actual income for the portfolio.
Is that cumulative
this is
earnings or
year by year? Yeah. So here showing that we were in compliance for the quarter, you can see on the left there the various security types that the portfolio held, the market values, and then the percent of the portfolio versus what's allowed by policy. And again, the policy is governed by California code, so everything was in compliance not only with the policy, but of course within California code. So this is an interesting chart to look at, but it shows the changes over time in the portfolio of the various sectors. One key thing that you'll notice is the grayish area here is U.S. Treasury exposure. And in June 2012, the makeup was actually very little U.S. Treasury exposure and a lot of agency exposure, which is this blue. Agencies being bonds issued by Fannie Mae, Freddie Mac, FHLB. And you'll notice that over time, they've actually gone smaller, and the Treasury exposure has gone up. Some of that being the fact that Fannie Mae and Freddie Mac and the agencies issue much less debt today. They actually issue very little debt and have been forced to issue very little debt because they've had to clean up their balance sheet and the amount of leverage post-financial crisis. So with that being said, and we've had a nice fundamental push where risks have been relatively low in some of these bond issuers, that the demand for agency debt still remains and issuance has been very, very low. So we've seen the spread, which is the amount that you're paid to own an agency on a yield versus a U.S. Treasury, become very, very narrow. And that's actually happened across the board, across many different sectors in the fixed income, where the amount that you're getting paid on yield to own a credit position over a U.S. Treasury is very narrow. So you're not necessarily getting paid the incremental risk, or it could also mean that things are very expensive relative to U.S. Treasuries. So since that said, things are relatively expensive, we've been adding more to U.S. Treasuries as U.S. Treasury yields have been going up in response to the rising interest rate environment and the fact that there's less issuance of agency debt today. We've kept a nice amount of corporate bonds and certificates of deposit here. The municipal market is becoming smaller and smaller for the taxable muni space. And then the agency MBS here is a very small sliver, but this is essentially mortgage-backed security debt. It's an area that we have not participated in the past. We've recently seen spreads, so the amount of compensation you get in yield for mortgage-backed security bonds, continue to go up, and that has to do with the Fed unwinding their balance sheet because they're at $50 billion less a month this quarter in repurchasing bonds in the open market. So there's a loss of demand in mortgage-backed securities, so the yields are going up. We like them from a more buy and hold strategy going forward, but we are approaching them cautiously still and monitoring the situation. Your portfolio is well diversified. On the left there you can see the corporate note issuers. You'll notice that we hold everything under 3%. So not only do we diversify by sector, but we actually want to diversify one level down, actually the issuers themselves. So not putting all your eggs in one basket again by sector, but also by the various issuers, and making sure that the portfolio is well diversified with no concentrated risks in any one company or any one credit. The maturity distribution of your portfolio is on this slide 10 here. The district's portfolio is the gray line, and then the benchmark is the blue. You'll notice the large overweight in the 0 to 1 year area again versus the benchmark. And this is again trying to keep the portfolio's average maturities shorter to lower the volatility to rising interest rates. And that metric that we look at is at the top right. It's called duration, and essentially your portfolio's duration was 2.33 versus the benchmark duration of 2.57. So the benchmark duration is much longer than your portfolio duration. So we are protecting the portfolio's principal by keeping the portfolio shorter than the benchmark given the rising interest rate environment. So what are we watching? On the top left there, we're watching corporate credit spreads. You can think of the corporate credit spread as a indicator for potential stress in the corporate markets. And what does that mean? The corporate spread, again, is the amount that a corporate bond will pay over a U.S. Treasury. And that's been very, very narrow and very low, as you can see here on the top left. It's been coming down. Now, it's been coming down because the risks associated with buying a corporate bond have come down in some sense, as most companies have performed well. There's positive cash flow. Their earnings have looked good. And so that being said, their risks have come down. And again, everything with bonds is about risk and reward. So if risks have come down, the yields have also come down as well. And the demand for corporate bonds remains very, very high, which is also compressing the yield, and the Fed's raising the rate, which is bringing the bottom of the U.S. Treasury yield curve up. So we are watching spreads. So if we see spread widening, as it has been this last quarter quite significantly based on a lot of the volatility we've been seeing in the equity market, that could mean that we become a little bit more cautious in the corporate world, in the corporate sector. We are watching a lot of the balance sheets of the companies that we're buying. There's been a lot of leverage that these companies, not in your portfolio, have added, but in other portfolios and in other companies that essentially, because rates were so low, they took on a lot of debt and they borrowed a lot of money. And now that if we do head to a cycle change, will they be able to pay that back if their businesses are challenged? And that's something that we want to be cognizant of and we look at. On On the top right there is the flattening of the yield curve that I talked about earlier. The key with that is you may hear something called the inversion of the yield curve. So here we're showing the 10-year spread versus the 3-month spread. And this is the same metric that the San Francisco Fed looks at. The spread is the area in green. As that gets smaller and becomes non-existent, that would essentially indicate that an inversion has happened, where you get paid more on a 3-month T-bill than you would on a 10-year Treasury note. That would be a very strong indicator of a recession. It's actually predicted the last 6 recessions. If you look there, the spread between them is actually still pretty wide, but there's some room, some compression that continues to happen. There is some narrowing that's happening. However, the narrowing that's being caused in today's market is different than in prior markets. And that's again because in prior recessionary periods, the Fed, leading to a recessionary period, the Fed was not raising interest rates. And in our period, the Fed is raising interest rates, which is pushing that artificial yield up on the short end of the yield curve. And then on the long end of the yield curve, it's still affected by the Fed's quantitative easing and the fact that globally our U.S. Treasuries still look very attractive. The market implied volatility, not implied volatility, but implied probability of a next rate hike is quite high. So the Fed met recently this week. I believe today they announced that they're going to hold rates steady, and they're going to be reviewing that again in their December meeting. The probability of a Fed rate hike in December is close to 100%, so we're expecting another 25 basis point rate hike to end the year. The future rate hikes going forward, the Fed has indicated another 3 to 4 based off of economic data, and the market probability says maybe 2 to 3. We continue to see in the longer term more rate hikes in the future. Outside of that, most metrics look positive, although we are starting to see more volatility in the equity markets, and we'll have to be cognizant of possible changes in the economy based off of any trade wars that could occur that could derail any future growth. So a little bit of the outlook and the strategy going forward. If we're going to be expecting modest growth and we expect the Fed to continue to raise rates, then we'll want to position the portfolio defensively still, keeping shorter. We also want to be cognizant that the markets could change, and if we do hit a recessionary period, that would actually force the Fed to, instead of raising rates, lower rates. And if that's the case, then you want to be longer duration. So we want to be at this moment in time, shorter than the benchmark, but not too short that we couldn't make a switch and be a little bit longer and extend ourselves. But again, this is in the future. We want to be very selective of the instruments that we're buying in your portfolio in case we do hit a bear market. And we want to make sure that the corporations that we buy in the corporate sector of the portfolio, that they're companies that we feel can pay back their bondholders. The right there shows some of the strategy highlights that we're looking at, and again, it's very similar, just managing the portfolio duration, identifying any market opportunities where we can take advantage of good bonds that come to market with good yields, and again, the focus is now on the corporate issuer level for us. Any questions?
Director Weed?
Your management fee. Do you happen to know what that is as a percentage of the return, and are these results net of that management fee?
Those results are not net of the management fee, but I want to say it's close to around 10 basis points of management fee.
So we knock off 10.
Yeah.
10 on these numbers.
I can confirm it's 10 basis points.
All right. Almost ready for a rhetorical comment here. I would note we're about a little over $100 million or something in total amount of money. Receiving something less than 2% on that.
Mm-hmm.
And the maximum investment is 5 years for fixed income. I would encourage the board to think in terms of the money that we're putting into our equity-based accounts with PERS and OPEB, where we're using 6.75 with our actuarial. So there's about a 4% delta there. 30+ million of the 100 million you have here is a budget uncertainty reserve because we have a dysfunctional rate structure. We cannot predict we have not matched our revenues and our expenses. for variable and fixed. If we were to do that, that would free up about $30 million from this that we could put into an account that would be generating another 4% in interest. So this is helpful. Thank you.
Director Huang? Director Akbari?
I don't necessarily agree with Director Weed on the rate structure, but that's my only comment. Thank you.
If we go back to the beginning of your presentation, where you were talking about GDP, I have a couple of questions and a few comments. In the reports on U.S. GDP that I've been reading, which go into much finer detail, the actual components of GDP, one of the interesting trends is that the regular press, blasts out the GDP was 4.2%, last quarter it was 3.5%. But when you look at the underlying data, what's really interesting to me is that most of the buildup is in, or most of the number is in inventory buildup. So for the last quarter, for example, GDP was 3.5%, but 2.1% of that was inventory buildup. And you go back to earlier in the year, it's the same thing with our GDP numbers, and they're even forecasting it will be true for the last quarter of the year. Why? Because people are rushing to bring in imports from China to avoid all the trade impacts from a trade war and the tariffs. So to me, this is a personal opinion, our GDP numbers are artificially inflated right now while people are doing all this massive inventory buildup. It's just a comment. Turning to your yield curve slide, right there, one thing that's become noticeable just in the last 90 days, I'm not sure if it's reflected here in your chart, but the short end of the yield curve is really flattened out. So it's even more pronounced than what we see right here on the chart.
Yeah, the yields since 6:30 have actually moved quite a bit as well. And just an example of that is the 2-year there, it shows at 2.53%. It's closer to around 2.90. So that, again, the yield curve continues to move on the short end, and that's again in response to the Fed's raising rates.
Yeah, so we're actually looking at more of a flatter curve like this.
Yes,
right now.
The good thing is we are starting to see the long end of the yield curve move a little more. So for example, here we're showing the 10-year at 286, and I think the 10-year is probably closer to around 318, maybe 320.
Right, and just to build on your point there, with the long-term rates going up, it's forcing up mortgage rates, right? And one of the leading indicators is on housing. As of today, we're at an 8-year high on mortgage rates, 30-year mortgages. So that may suppress a little bit of the activity in the forthcoming quarters.
Yeah,
Just
so
again, a personal opinion.
Yeah, no, we are starting to see softer numbers with housing. So when you do look at the mortgage rates being at an 8-year high and prices of homes in general continuing to rise, we've seen new home sales decline in recent months. So we have started to see softer data in the housing market.
And I'd like to close out on one other observation where you had the distribution of our investments by type of investment. The slide before that one, right there. Okay, so one thing that has caught my attention, especially if you walk into any bank, you see the signs up, the banks and everything. For the first time in years, banks are encouraging you to buy CDs, certificates of deposit. And we have CD rates right now that are exceeding the short-term treasuries. So there's a little bit of a spread, maybe about 30 basis points or something, but you can actually put your money into CDs which in my opinion is just as good as cash.
Mm-hmm.
You know, it's backed up to $250,000 in the bank. Without the downside risk of buying the treasuries because of fluctuations in the bond market.
Mm-hmm.
And I see that we're below our permitted policy levels there.
Mm-hmm.
And I don't want to suggest that I know your job better than you do. But I would like to suggest maybe taking a look at whether it might be worth putting more of our money into CDs, especially those shorter term ones.
Mm-hmm.
Maybe the 2-year and less.
Mm-hmm. So I will say that so towards the end of the year, the spread, the fair value trade between short-term negotiable CDs and commercial paper versus U.S. Treasuries came down. Typically, you would see a fair value trade of around 20 basis points for a commercial paper or negotiable CD under 1 year in that short-term space. Again, 20 basis points. That's been around down to 12. It whittled down to about 12, making those again relatively more expensive. So in December, since we're expecting the Fed to raise rates, we expect those yield spreads to widen out again, making a good buying opportunity for those types of instruments. So it's very likely that come December, there should be some increased allocations in the portfolio that in that area if there's bonds that are short enough where we feel we can sell them in the market, maybe take a loss on that position, but by buying something with a higher yield, we will be able to offset that loss by the next payment of the new position.
Mm-hmm. Mm-hmm. So we're at about 12% in terms of our portfolio invested in negotiable CDs. Our limit is 30%. What do you foresee as being a reasonable investment level for that part of our portfolio?
Yeah, I mean, I think that right now 12% is good based off of what we've seen in the market. I would say, there's some possibility maybe to bring it up to about 15. I would be a little bit more cautious to say let's bring that all the way up closer to 30. Again, in order to do something like that, you have to sell something, right? And in the environment, you want to let things come closer to maturity, because you do that, it minimizes the potential size of a realized loss. And so there are opportunities with corporate bonds, and there are opportunities with negotiable CDs that look attractive. I would say maybe around 15%. However, because the yield spreads are so tight right now, that's one of the reasons why you see the larger U.S. Treasury exposure. It's called having dry powder. In investments, they say having dry powder, and that essentially is implying that the portfolio manager is keeping some dry powder on hand so that when spreads do widen out and there becomes a buying opportunity, that they can use the U.S. Treasury exposure to buy into the credit market and buy some higher yielding positions.
No, I fully agree with you.
Yeah.
I don't know how long it's been, because you're an expert at this, but from my recollection, it's been years and years since we've seen CD rates in the short term exceeding treasuries.
Yes.
I don't know when the last year was, but as soon as I started seeing that, I go, wow, sometimes it's better to keep your money in cash and earn that higher rate than take the risk on the bond market where you might be selling the bonds for a lower price at a future point.
Yeah. Yeah, no, that does make sense. And I will say that the negotiable CDs in your portfolio do have attractive yields. Some of them that are coming to market around 289, 290, 3%. And so those are quite meaningful yields from where we were in the past. And as the rate environment continues to move up, those rates will continue to move up as well.
Yeah, I saw some 2-year CDs being advertised over 3%, like 3.12, things like that.
Yeah.
So, okay, good. Great presentation.
Thank you.
A lot of information.
Great.
Thank you.
Perfect.
Hope you have an easy ride home.
So we're up to item 6.3.2, District Workforce Engagement and Retention Efforts. So the board has expressed concern about the district's ability to attract and retain high-quality employees. And this board direction has been memorialized in our strategic plan. And I'm happy to report that staff has made this a priority issue to bring this issue back to the board. And under Ms. Solito's leadership, a lot of progress has recently been made. Stop it, phone. Beginning with the cough assessment and now accelerating with some recent studies that we'd like to share with you. So with that, I will turn this over to Ms. Solito, our HR manager, who will get you up to speed on staff's efforts on this topic. Thank you.
Thank you. Good evening. So as Bob kicked off, we're going to focus on two main points tonight. First are some employee retention data. So we'll show you some historical attrition data, as well as some research that the HR unit had done on some comparable agency practices and best practices in retention, and talk a little bit about what we've done in the last couple years related to retention. And then move down into employee engagement and specifically talk about the recent employee engagement survey we did this past year and the employee engagement action plan resulting. So first, as Bob mentioned, why are we here? It was part of the strategic plan. HR's item is strategic goal number 4 related to workforce with specific objectives to improve recruitment procedures to ensure a high quality and diverse workforce, maintain retention levels, and enhance engagement. And one of the action steps was to present to your board on retention best practices. So that's checking this box today, and we want to talk a little bit more, focus it on employee engagement as well. And I added this little picture here because we'll talk about diversity a little bit later, but workplaces in general, and I will highlight why we're not quite there as a district, but it's a really interesting time just for the workspace in general, where we're about to enter or are entering the first time, I think, ever, where there's been 5 generations potentially in the workplace that are shown here. The district specifically, we're from boomers forward. So we have 4 generations in the workplace, but that's still a pretty big difference that we're having to deal with. And that's sort of challenging all workplaces to kind of be more nimble in what they're offering employees and evaluating their positions in terms of being an employer of interest in order to maintain retention as well as engagement. We talked about demographics in the strategic plan presentation earlier in 2018, and that's something that the district's continuing to strive for in terms of all kinds of diversity, including generational diversity. It's important to accomplish the district's mission the best way possible. So I'll come back to the concept of diversity, but I wanted to tee that off in the beginning as to kind of why this is so important and one of the key functions for HR to look at. So I want to switch over to retention. I'll show you some, in the next slide, some historical attrition and retention data, but first kind of wanted to give you some definitions of what we're going to be talking about. So when we look at attrition, we typically summarize them into 4 categories. So we have retirement, which is pretty self-explanatory, and then 2 types of voluntary separations, which we define, HR defines as regrettable or non-regrettable involuntary separations, and then terminations. So going backward, termination would be a non-voluntary separation, such as a firing. A regrettable separation is someone that left probably for one of these 4 reasons. They got a new job, a promotion, they're relocating, family obligations, commute, but we would have liked to have retained that person. And then we have a separate category of non-regrettable voluntary separations, which are typically situations where somebody was given the opportunity to resign in lieu of termination. So we do differentiate those because there are some attritions that are measured slightly different than other types of attrition. Some we'd like to avoid, some we're kind of okay with. And I did want to highlight the common reasons that we see for the regrettable voluntary separations are listed here. And the new job isn't always a promotion. And this is something when I was looking at the data for the last year and a half, we're seeing a lot of people leave for new jobs, but it's usually tied to commute in order to try to reduce their commute, which is also tied to housing. So that's kind of a new thing that we weren't seeing in the last couple years of data, but people giving their reasons for leaving has been more recently for commute, not necessarily to take a higher promotion or pay. So this slide, you can see this from a distance, shows the last, going back to 2013, the last 5, and then year-to-date for 2018 years of our attrition data. So the blue at the bottom is retirements, and then the purple, separations. And that would be the voluntary, potentially regrettable separations, and then the green are the non-regrettable separations. So what the district really wants to focus on is that purple bar. In general, very vague general comment, that a healthy turnover figure for any organization is 10%. That idea behind that is you're getting new ideas, innovations, fresh perspectives. Ideally, though, that's not your top 10%, right? That would be maybe your lowest 10% of engaged employees or somewhere in the middle. So you want to look at, even if you have 10%, it might not be a healthy attrition if it's not like the right 10% that you want. So the district's goal here is focusing on lowering that attrition of the regrettable, voluntary, non-retirement separations. And to give you some ideas on comp data, if we look at our 10 of our sister comparable agencies in fiscal year 2017, the average overall attrition for them was 8.27, and we were 8.7. So we're right about average there. And the average for a state and local government nationwide is 18.7. So we're definitely faring better than some public agencies. We have a lot of retirements, but that's pretty common in the public sector, especially given the age of our workforce. So we see the attrition data ticking up, which isn't necessarily a bad thing. You see those purple bars getting bigger, but it is something that we should be aware of and watch and try to understand. So HR tried to do some research into what are the best practices around retention, and I thought this slide was interesting. This is a Gallup poll that specifically asked what it would take for an employee to leave. So not necessarily why they're staying, but what would it take for them to take a new job somewhere else. And the 5 listed there were ability to do what they do best, so enjoying their job, right fit to the right skills, greater work-life balance and well-being, greater stability and job security, a significant increase in income, which was interesting, not just an increase, but a significant increase, and then the opportunity to work for a company with a brand and reputation that they, felt connected with. So we hear a lot of chatter about the millennial generation, kind of wanting and demanding different things from different cultures and their employers. But I want to stress that these factors are changing for all employees. It's not just certain generations. So we really want to focus on the general retention and engagement of all employees as that interest evolves as a whole. This list of things that I used to kind of hear connected to millennials, but this study, this was everybody, right? So this isn't unique to any generations anymore. And another point that I think is interesting is the labor landscape is changing for all employees. And sort of the general concept that the amount of labor it takes to have a high standard quality of living has dramatically fallen in the last generations and will continue to do so. If you think about how much time, labor time, does it take to buy clothes, food, televisions, cars, in previous generations it took a lot of labor time. That's not really the case anymore. So because of that, workers are changing what they value and prioritize. It's not all about the compensation. For some, it will be, right? They're always going to shoot for the highest line. But for some, they're going to think about what do they need to kind of hit that minimum quality of life and what are their other values. And that's where I think we're seeing a lot of the shift around, the work-life balance, the flexibility, the commute is becoming, less of something people won't stand for so much anymore. And that's really requiring employers to sort of consider their culture, their values, their brand. If we look at this list, the district can check a number of these boxes, right? We have great stability and job security. We have great incomes, compensation in the workplace. But it's good for us to be aware and kind of keep these things at the forefront. So in a similar vein, when we did research, so the last slide sort of showed what would it take for you to leave. This slide's talking about what will it take for you to stay, what were the common themes in retention. And these were the highest drivers across various studies and sectors of studies that we looked at. So professional growth was one of the highest we see repeated. That feeling value, feeling loyal and proud of their employer brand. Then communication and connection with the mission and the brand that they value. Workplace flexibility is a very common discussion, including scheduling flexibility, non-standard or rigid work hours, part-time work, and then a move away from the traditional office environment. Next, kind of dovetailing on that, is work-life balance. Although you're starting to see that be discussed as a work-life continuum that should be integrated, not necessarily a balancing of the scales. And then this concept around community, social wellness engagement, and what the employer does and how they connect with the community. And then technology, always, they want to be somewhere where they can leverage the most innovative, top technologies in the workplace. So we looked at our 8 sister comparable agencies and kind of asked them, what do you provide? What are sort of the perks you provide related to retention? So this list shows retention and engagement benefits that at least several of them offer. More than one of them said they offer these things. And then the checkbox you'll see is where the district is at. Do we also offer it or not? And 2 of the things I want to highlight, one, telecommuting and the employee suggestion program. I'll talk a little bit later because that is something the district is actively pursuing, but I'll talk about that related to the employee engagement action plan. So the next slide, we also looked at what large, local, but private companies with which the district competes for job candidates offer. So many of these perks companies provide are something that the district really could never directly compete with. We're never going to offer free lunches and certain things on this list for obvious reasons, gifts of public funds, public perception, and then some logistic limitations. But it is good to be aware of what we're competing against so we can try to make strides in order to create different but equally attractive culture and environment connected to these things. And what this chart doesn't show, which I think is important to highlight as a government agency, is we have several sort of retention best practices as a public sector that private sectors either can't or don't offer. One of the big ones being pension, right? Private companies typically do not have pension systems. They may try to replicate that with what are usually more risky or less secure options, such as bonuses or stock options or deferred comp, but it's not quite at the same level as what we're able to offer as a pension. And then retiree health care is one that you almost never see offered in the private sector, including with the FANG, the big ones, Facebook, Amazon, Netflix, Google, or any of the other big companies haven't broached that. So we do have a couple perks that we have that they don't have on this list. So what has the district done just in the last couple years? In 2016, we implemented a district-wide employee wellness program, which hits on those various wellness items we saw on those retention lists. We've also tried to increase the communication as a whole district, have people feel valued and connected to the mission and the district as a whole. In 2017, we implemented 2 different training programs, of supervisory skills training and then just general skills training, and upped our tuition reimbursement program, kind of expanded what was allowed there to try to hit that professional growth category. And we've also expanded the use of social media in terms of branding and attraction and trying to place ourselves as an innovative employer in the workplace. And then this past year, as I mentioned, we had our first employee engagement survey, and then we have continued with the recent changes to remain highly competitive in the market for compensation as well. So I'm going to switch gears now to employee engagement, but I get asked this all the time, like, what does that mean? So employee engagement is generally where we want to focus on, right? So engagement is what's most valuable in order for us to attract and retain. We can have really high retention, but if we have really low engagement, we're still not a high-performing organization. So when we talk about retention, we try to talk about engagement at the same time. And so engagement is generally the level of commitment, passion, and loyalty an employee has for their work and for the district. And engaged employees are more present, focused, energized. They go above and beyond, the minimum call of duty because they feel part of a purpose larger than themselves, connected to the work group, connected to the district. And engagement is greatly impacted by morale. Morale is one of the biggest drivers for an organization in order to impact engagement and improve efforts. And better morale means better employee satisfaction. Generally, they're more positive at work, they're more creative, more collaborative, better communication. And that impacts the whole rest of this list around retention and traction, productivity, and innovation. So, in March, we did our first ever employee engagement survey. We contracted with CPS, a third party, so they could be totally anonymous, neutral in conducting the service for our employees. As you'll see here, where are we? We are the rightmost bar, and this is comparing our survey results to the private sector, general government, and then more similar to us, local government agencies. So as you can see, we're pretty much on par with public sector. Private sector generally has somewhat higher levels of engagement for a variety of reasons, but we're pretty good compared to comparable public sectors. And I want to highlight our response rate, because CPS indicated an average response rate of 60%, and we had 86%, which was stellar response rate from our employees, way higher than we expected. So the survey was made up of 92 multiple choice questions and then had 6 demographic questions so we could break down the reports into different types, and 2 open-ended questions about if employees plan to stay or leave, why, and what they thought would make the district better. So we ended up having a lot of reports, right? So the CPS reported on groups of 10 or more, 10 being sort of the magic number to keep things anonymous and confidential. So we had 28 reports broken down district-wide by departments, by division, by staff level, by union group, tenure. So this is just one showing of one of those breakdowns. This is the engagement by department. So each of the 5 departments within the district had a response rate of more than 10. And as you'll see here, you start seeing some variances in the engagement levels across the departments. And as you can imagine, when we drilled down into the other 28 reports, we saw even more variances in those. So that's the survey in a nutshell. What that resulted in was CPS giving us a recommendation report with 86 recommendations. And they divided that out into 12 areas that they identified as general themes that they thought the district could focus on either improving or things we're doing pretty good at, and we should try to maintain those in order to continue our levels of engagement. So what staff did is kind of broke those down. We measured those in terms of how much time it's going to take, effort, and then tried to prioritize all those 86 recommendations into things that we thought were feasible, that we could do immediately, might have the biggest bang for the buck, and develop that into a 2-year action plan, which looks like this, which I don't expect you to read, but I highlight this as a very involved document. Each of the 86 recommendations are listed here, talks about what it is, the rating that they were given in terms of priority, cost, time, and then what the district plans to do with those recommendations. So at a very high level, I'm not going through all 86, I want to highlight the 2 major, what we plan to do in the next 2 years. So big one, performance development. There was at least 12 recommendations that were all around professional growth, trying to provide more training, career paths, providing folks different projects and their worth for professional growth. A lot of recommendations around that. One of the things we plan to do in 2019 is to overhaul our performance evaluation system, which is could use an overhaul. We're going to do that in 2019. And also implement 360 performance evaluations for all the division managers. Department heads have already been through that process. We're going to go down a layer to division managers. Jumping back to the second bullet, exec staff, there was a lot of feedback about wanting exec staff to kind of build accessibility and visibility, maybe be more present in the field, have more opportunity to communicate and speak with them. So there's a number of recommendations we're focusing on, trying to include more visibility there. One small thing that's already been done, but this kind of gets to the communication, was rescheduling these DIPS presentations, which happen once a month in the afternoon. If we moved them 30 minutes earlier, then the field staff could come, because they were occurring like right when they got off work. So that's one that could make a big difference in terms of communication and having people feel connected, and was super easy to change. There's also the recommendation to provide training for all staff. It's the first time we've done this on one topic, promoting a respectful workplace. So that training actually started earlier this month. The recommendation to implement a whistleblower program, which is very common in government, but we don't really have a structure here for that. That's truly anonymous, right? There's places for people to go if they have concerns or complaints, but it has to be to their supervisor or to HR. So this program would provide real anonymity. And then the telecommuting pilot program. I'm highlighting the pilot, a new program that we have been working on implementing and drafting here. The plan right now is to implement it as a test for MCP salaried employees only, and sort of see how that goes. There's a very rigid policy and some testing and surveying around that to see how successful it is. And right now we're tracking for potentially some sort of implementation around January timeframe. And then last bullet, there were a couple areas of the survey. Because it was multiple choice, it's hard to understand the why. Right? We saw what people rated, but we don't necessarily get to see from the survey why things were rated that way. So there were 4 specific areas where the engagement level sort of varied markedly from the average, from the rest of the district, and from the comparable agency average. So we are planning to do kind of a deeper dive, what we're calling a cultural assessment, into those areas to try to understand, what was the basis for those scores. So that's a lot in year 1. In year 2, a couple plans we have is to implement a change management process. So it would be a single, consistent philosophy that's trained for all staff, and that'd be how all projects are managed going forward. Also develop specific district core values in order to sort of drive culture change and focus our mission around. Develop a more robust onboarding program, including maybe some sort of mentoring program. Generally try to find opportunities to build the culture that we're trying to drive through the core values through different events and relationships. And then consider a communication master plan for the whole district. And then a couple pieces that I want to highlight that we may or may not pursue within those 2-year mark, but are kind of high value items on the list, would be to implement a revamped employee innovation or suggestion program. Again, right now there's sort of a method for it, but we could use some more kind of rebranding and breathe new life into that program. And implement a formal employee recognition program beyond years of service. Right? Most of our comparable agencies have some sort of program like this that doesn't just address how long you've been here, but more your contribution and your work performance. And then consider, the feasibility of having a more robust, organized mentorship program to try to help with professional growth. And that's where we're at today. Any questions, feedback?
Good presentation.
Thank you.
Any comments from the board here? Questions?
It's one of those areas which is so massive and detailed that it's difficult to it can't even summarize at this point.
I was trying to hit 10 slides. I think I got 20, and there's still way more I could go down into this.
This will be a long-term. Hopefully there'll be some board engagement as we develop some of the options. Thank you.
Any comments?
Nothing from
I'd like to, I'm a big advocate of the telecommuting part. I think that really we have room for that. Obviously, I work for the railroad. You can't telecommunicate in my position. There are staff positions where you can't do it. But there are positions, and I've always felt that with the technology getting better as it is today, commutes are a big thing. And it really, I think there's a perception that, they're not going to be as good if they work from home, and I would challenge that perception. I've also felt that adjustable work schedules, I think it's the 4 9s and the 4 10s, and I've always felt that I've known some people that worked in some government agencies, and it was always funny. The high-level elected officials were always expounding on how, we could do this and we could do that to save energy and the economy, and yet when it came to their staff, it was like, oh no telecommunicating, no flexible work schedules. And these were in departments that led themselves. They were like beautiful locations for that. But the supervisors in those departments wouldn't let it occur. So I really like this. I'm happy to see that in there. I think it will be successful. There's always drawbacks. There's always risk. But I think the benefits will outweigh will certainly be a good game.
I actually did have one
Please.
For the item on transportation to work, I know we had explored potential programs to encourage our employees to utilize BART, especially now that the new Warm Spring station is open. And I was wondering if you could potentially give us an update on how those programs went and where we stand on that currently.
Yeah, so when the station just opened, we kind of did some research because it's, I think, almost exactly 1 mile away. So we put out a lot of information to folks about, how long it would take for them to walk and local bus routes, biking, and we do have a commuter benefits program that we offer, kind of like an FSA program, where they can set aside, funds to help with that. We did call a lot of local agents, the cities, Tesla, some of the big local, the school district right across from the business park, to see if anyone was going to be running shuttles that we could maybe tag on to. And they weren't on our track. Tesla's the only one that offers shuttles, but they don't actually go by us because they're down the other way. And the cost of the shuttle was, to do it ourselves, just for us, was substantial, like very high cost per day to do that. It was very cost prohibitive. We did offer, and it was used for some period of time, actually, by Megan, as one of the participating employees, a district vehicle that we allowed to be used to take folks to and from the BART, so they had to kind of coordinate their schedules, and I think they had at least 3 or more. It was a vehicle that was near end of life, and we were able to talk with BART about essentially a no-risk free parking situation. So the employees coordinated their schedules. They would, go take BART. The car would be there in the morning, drive in, and then use it in the evening. But we've had a couple employees that were using that program that aren't here anymore. We don't have the level of participation anymore to keep that car running. But it is still an option if we had enough employees come around.
I would encourage us to look into programs that partner with, like Lime Bike, or with some of the scooter companies that are coming into the area, because those you can pick and drop wherever you want, and they're relatively cheap. And so that would be a great way to close that last mile gap between BART and HQ.
That'd be great. Thanks.
The official new state sport signed by the governor is surfing. Since we're in the water business, maybe.
A little hard.
Quick follow-up on Director Akbari's comments on the transportation. The City of Fremont is developing some internal transportation for the Innovation District around the Warm Springs BART station. Many of those are at beyond normal walking distance. They've shortchanged their parking by at least 1,000 parking spaces for the Innovation District, with the argument that they're going to have an internal transportation network. I would encourage us to see if we could be incorporated in that Innovation District plan for internal transportation.
Awesome. Great. Thank you.
It might be getting ripe now that the buildings are actually coming together.
I'd like to ask, did we survey our employees as to, what percentage of our employees actually are willing to use BART to come to work?
We did when, before we did the whole BART car thing and really got into that research, we put out a survey saying, here's how far it is and what would you consider? Because we looked at even renting bikes, because folks said they didn't like having to take the bike on the BART. They wanted to be able to leave it and not have to take it to and from. And that was right before the station opened, and there was a sort of a low, we maybe had 30 respondents, and a lot of those said, here's why I don't take the BART, for scheduling reasons or safety, whatever it was. And then we did hold an FAQ section, which maybe 5 folks attended to kind of brainstorm and get ideas from folks that were taking BART about what it would do. So we still have a couple employees that do bike on their own, and I think there's one that maybe takes the bus. So we did ask, but it is a low percentage.
We learned that BART has a sort of reliability reputation problem. Hopefully that improves with the addition of new rolling stock and some of the track improvements they've been making. But I heard from several employees that they feel that they have a better understanding of what their predictability is getting to work in traffic in their cars than they do on BART.
Okay. Let me make one more comment on telecommuting. I know that a few years ago, Intel and some of the other companies were setting up satellite office space. So when they had a complete breakdown in the freeways, or their buses were, and the commute was getting particularly long, they had a place they could go and do the work. Finding a satellite site, possibly even at another utility, might be a location where people could go and be in an environment where they could continue their work and have the structure. Having the personal discipline to work at home on a computer is a challenge for everyone, and not all are capable.
Okay, so I just have to jump in on telecommuting then. So I actually telecommute. I officially telecommute 3 times a month, perhaps more, once a week. Depends on the schedule with ACWD. And I actually found it as a very good opportunity to get a lot of work done. Being in the office environment is a really good collaborative environment. But once in a while, you do need to focus on a specific project without interruptions. And those are perfect items to work telecommuting from home. So they're actually, not everybody can telecommute, I will agree with that. But they are actually great opportunities. People are actually more productive just because you don't have that interruption. But I would also like to caution that telecommuting, we also pick up liabilities. So make sure that in the policy, we have a checklist, make sure that the district is protected from working from home. All right?
We do, absolutely. And actually, the policies with Pat right now being reviewed for additional liabilities.
Thank you.
I'd like to ask a couple of follow-up questions. So do we have any feel for people that work out in the field, which is more than half of our employees, right? Whether they use BART, or is it more a sense of people that are working right here at the corporate headquarters?
The only ones that I'm aware of are the ones at headquarters. TP2's sort of far from the BART, and then the crew guys, because they start so early, they're not as impacted by the commute, and their schedules might be prohibitive for some of the BART schedules.
That's
too.
what I figured. So, is it worth looking at purchasing just a few vehicles that can be used back and forth between BART? Because we can amortize the cost of those vehicles over a long period of time, and if they're only going 1 mile, just buy the lowest cost-effective vehicle, because you're talking about different times of the year and weather conditions and everything like that.
So we did try using pool vehicle to do that, and we were having difficulty coming up with any economy of scale. We tried to have a minimum of 3 people take advantage of the vehicle. We can periodically try to see if there's interest using some of our older pool vehicles. I would do that before making any purchases.
Just an idea.
Yeah.
Then I wanted to follow up the consulting firm that came up with the 86 recommendations. That's a lot of recommendations.
Yes.
And it's a 2-year action plan. Is there any way of setting up some metrics for measurement that 2 years out we come back and take a look at this and we say, have we succeeded in our effort here?
Great question. The plan is to actually redo the survey every 2 years. That's sort of the best practice to see, are you moving the needle? So we want to give ourselves 2 years to implement some of the recommendations. Hopefully that's helpful. Test again and see if that helps or not and what areas, we're changing in.
So that's the response from the employee end. What about from a professional end, like the consulting firm that made the recommendations?
Oh, that is one of their recommendations, sort of best practice that you retest. And I think that is best practice not only from their job security standpoint, but that is most common in the area. And then they have a number of their recommendations. They don't necessarily have specific metrics associated with them, but they say to look at your attrition, look at your turnover, look at your performance development scores, things that they advise us to consider in terms of metrics for measuring success.
So hopefully 2 years from now, you're going to be able to come back and...
That's the goal, have some positive uptick, hopefully.
We made good progress?
Mm-hmm.
Okay, good. All right, so that's all I have.
Should we proceed to
Yes,
General Manager's report?
report?
Okay, just a quick reminder, once again, December 6th, Board Workshop. I also want to at least publicly acknowledge the promotion of Laura Highness to Water Resources Manager. Really excited about her taking on that responsibility. But please don't bother her too much yet. Stephen Inn is still our Water Resources Manager and will continue to be so until December 21st. We're planning a retirement celebration for Stephen on December 18th. And also just wanted to give you a heads up that on December 13th, I will come back to the board requesting authorization to bring Stephen back as a retired annuitant for 6 months or so to assist primarily with covering with the state water contractors, the California water fix related activities, to keep continuity as we're in very sensitive time regarding that mega project, the California water fix project, as well as helping to bring Laura up to speed on what has been described to me as at least a 2-year learning curve in reality to get up to speed on state water project related issues. So with that, I don't believe we have any other General Manager report items. That's it.
Okay, on to Section 7, Director's Comments, Reports on Meetings. I'll go last if there's any others here.
I don't know of any meetings that have been recently, but I would like to make a comment, an explanation, maybe an apology. I made an intemperate response to a question of whether I felt the district was being well managed. And I believe it is being well managed. I have concerns, and the concerns about the issue, which was around rates and rate structure, relate to governance, not the management of the district. And that is appropriate for the board level. I would like to commend the staff for being dedicated professionals who have worked diligently under guidance which at times can be confused. Thank you.
Thank you.
Nothing for me?
Talking about Delta conveyance? Yeah, I think we could. Maybe I'll let you open up that subject. I'm sorry, we got a little distracted here.
We both passed. Director
Passed,
Gunther.
okay. So, why don't you go ahead?
Yeah, there
here.
was a meeting, I just wanted to bring up that the General Manager, correct?
Executive Director.
Executive Director of the
Delta Conveyance
Delta.
Finance Authority.
That's Brian Thomas.
He came up, we had a meeting with him, myself, Paul, and Bob. I think it was a very productive meeting.
And Stephen N.
And Stephen A. was there too, So he got, I think, a pretty good feel for who we are, why we do what we do, and why we're interested. So I just wanted to bring that to the rest of the board's attention. It was a very productive meeting, I felt, and I think he went away with a better understanding of who ACWD is.
Just for recreational purposes, there was also discussion about potentially early participation by Alameda County Water District as well as some of the other partners on tasks that could be done to keep the California Water Fix project moving in terms of financing some of the earlier action activities. Maybe more to come on that, but just wanted to make sure that you all heard that.
So our next meeting is scheduled for November 15th, next week, next Thursday, in Sacramento. I'm going to be covering 3 bases that day: the Delta Conveyance Finance Authority, going over to the Delta Conveyance Design and Construction Authority, and then I have my responsibilities with the Aqua Business Development Committee meeting at the Aqua headquarters, all within a few blocks of each other. So I'll be hitting 3 birds with 1 stone. And I will report back on that meeting at the December meeting that we have here for the board. I think there are some creative financing things being looked at. It was notable that we were not accepted on our first round on the WIFIA application, which was somewhat disappointing. There probably will be a refiling next year, and that's what's prompting a look at some other financing options right now, and we were exploring those in the meeting here. I gather from some emails that were sent around after the meeting and through the weekend, because we have some other water districts potentially coming on board, Coachella Water District, Santa Clarita, Mojave Desert. Is there one more?
I'm not thinking of it, but I think at least those 3.
Yeah. So, it seemed like Brian had been talking to people after our meeting, and it was almost like he was doing reconnaissance here on our agency because other people don't have a really good feel for us. But what I gathered is that he came away with a very favorable impression about the stability of this agency and the fact that we were unanimous in our support for California Water Fix, whereas the other water districts are all split up. That moving forward politically, we may be in the most strategic spot to help out, just like we were in getting the JPA off the ground. Other districts came and looked to us to help initiate things. Speed is of the essence here, and so you don't want to go through lots of deliberations at other water districts to get things moving forward, and we may be the fulcrum to spur action here. So it seemed like from just little emails I saw that there was a favorable outcome from that meeting.
You mentioned 2 activities that are coming up. One, I believe, is a webinar on Tuesday morning with PPIC on water policy in California and tying in some of the expectations of the governor, the new governor. And the next is a Region 2, I believe, a tour of the Sacramento area on the 15th, which is Thursday, the day you'll be in Sacramento.
Region 2 and 4.
2 and 4.
Jointly.
And I have a BOSCA meeting that evening. I would have to take a look and see if the logistics would work to go and come.
What's that Monday meeting you just mentioned? PPIC?
I believe it's Tuesday, and it's a PPIC. They're having a meeting in Sacramento, which is filled at this point, but you can watch the webinar from 9:30 to noon, or 9 to noon.
Okay, I'll just give a brief report on 7.1, the Alameda County Watershed Confluence Conference in Oakland. I attended with, I believe, 7 district employees from our staff, so it was very well attended on our part. I found it, first of all, an absolutely wonderful conference to attend. The Director Weed and I have gone to it before. And so we've seen it from its inception to growing into this very nice, healthy group of people that meet and talk about all the watershed issues in Alameda County. And we had compatriots, directors from our other boards and staff. So it made for a really nice opportunity just to share issues, what's going on. You know, you don't have very many opportunities to meet with your fellow directors from East Bay Mud and Zone 7, Dublin, San Ramon, so that made it all worthwhile. There were, I think everybody had the same opinion, 2 outstanding presentations that day, and they were both from the Alameda Creek Alliance. And the first was more of a technical overview of what Alameda Creek Alliance has been trying to do in Niles Canyon and the watershed. And then our good friend Jeff Miller gave the afternoon presentation and received the top award for all his work over more than 20 years of trying to pull everything together on Alameda Creek and the fish ladders. And he gave an excellent presentation. It was by the way, I would like to get a copy of those 2 presentations. Jeff's presentation in particular, I think would be useful for our community. It provided such a rich history from the very beginning, going back in time to fishing on the river, to organizational efforts. ACWD stood out like a star in both of these presentations, and crowd loved it. And I also, you know, sometimes you have to dig in a little bit deeper to learn what's going on with things outside your own district, but still within the water interests and what's going on in eastern Alameda County. So they had this one period during the afternoon when people tend to fall asleep, where they wanted to keep it lively. And it was like speed dating, but they had speed presentations. And everybody got 5 minutes to talk about what their organization is doing on every effort in the East Bay. So they had one on all the activities around Lake Merritt, on all the creeks in the San Leandro Hills, Lake Chabot. They just brought it straight down to Fremont. And it was exciting to see how many volunteers there are on these different creek cleanups that are multi-year projects, by the way. Director Akbari, you brought up in the last meeting trying to engage young people that are in high school or even junior high. And one after the other, they were showing successful programs of engagement with these younger people, really pulling them out from the schools and getting them active in doing hard work that they can feel good about later on because they're part of the community. And so I found those presentations just you think you know 10% of what's going on in the world, and then you find you only know 1%. So that was really good, and that's all I'll close on. We'll go to closed session, section 8. It's 10 after 8, and I'll turn it over to our general counsel.
Yes, the board is going to convene in closed session pursuant to California Government Code Section 54957.6, conference with labor negotiators. Agency designated negotiators include Robert Shaver, Jennifer Solito, and Glenn Berkheimer, and the employee organization is the ACWD Operators Association. We now convene into closed session.
All right, folks, we're reconvening at
Okay.
8:38 in the evening.
Okay, at 8:38, the board has returned to open session, and the board is returning from closed session, and in closed session pursuant to California Government Code Section 54957.6, a conference with labor negotiators. The agency designated negotiators were Robert Shaver, Jennifer Solito, and Glenn Berkheimer. The employee organization is ACWD Operators Association, and during closed session, the board provided direction to the agency negotiators. And that concludes my closed session report.
Any other board comments? Nothing? Okay, we'll close the meeting.
We adjourn at 8:39.